FUD, the spread will remain pretty wide. Can they do the same techniques to massively short the stock down so January doesn't happen? No. Okay, listen. If they short the stock, it creates FTDs. Shorting, creation, whatever. Covering gamma exposure. So if they bring it down in order to avoid exposure, they create FTDs. If they cover the exposure, they create FTDs. You guys are just falling for the game. I don't know if it's that you don't understand, and I'm trying to determine this because I can explain it. Do you not understand how the gamma exposure works? So if this is the zone where they have gamma exposure, and they short the price of the stock under it, then their exposure is minimized, right? Because many of these options are no longer in the money. They are out of the money. Hence, no exposure. That means these options are not getting exercised. They are not hedging them, right? There's no delta hedge, so there's no synthetics used to delta hedge because the delta value has dropped like a tank, right? But in the process of doing this, they create shares. Their shares, then FTD. So they either FTD before or they FTD during. If the gamma exposure and the delta sensitivity were as high as we thought, had they run the stock, it would have ripped, right? Based on Yelya's delta sensitivity model, every 5% gain would have netted like 800 something percent delta hedging. So they would have had to have hedged 800% for every 5% gain in the underlying. So their best bet facing that kind of gamma ramp is to short it under the ramp. Drive the price down as much as they feasibly can. And in doing that, they create FTDs. There's no solution for them not to create FTDs because the stock is illiquid. The stock cannot be bought and sold at market in any significant quantity without creating a lot of volatility. I mean, our volume over the last 2 weeks was some of the highest volume we've seen on GameStop since earlier this year, and it was all synthetic short volume. Is now a good entry for cat or too late? I think you missed the window on that. You could try to play the upside of 210. I would give yourself a lot of time. And it's risky. It tends to get rejected there. Um, it's had 1, 2, 3, 4 tests of 5 tests now. So 5 cycles I've played this drop below 200, and let's see, I could easily get rejected again before breaking out. So it's risky to play the upside of 210. It broke out here a few weeks ago, back in early November. But that's been the only breakout outside of this channel. So yeah, I would say that this isn't the best buy-in point. But it could, and the upside potential is huge. So when I look at calls on cat, I tend to buy very far out. It's a slow moving stock, but if it starts to break out, you want to be already in on it. Can Jimmy theoretically benefit from a significant influx of retail share purchasing, or do the exposure windows play the most significance for future upward price movement? Every time retail buys a share, if the stock is as liquid as we think, it creates an FTD. One share for one FTD. That share is synthetically created via bona fide market making in order to provide liquidity, and an FTD is born. I just added 5 XRT calls. That might not be a bad idea. Clippy, clip this. Okay.